The May jobs report is out. 339,000 jobs were added last month, almost twice what was expected. And the unemployment rate, though, rose 3.7%. Not a lot relative to, the bigger news, of course, is the high amount of jobs that were added. So joining us now to discuss the impact on crypto is Coinbase institutional head of research, David Duong. Welcome, David.
Thanks a lot, everyone.
Thank you for being here. So, of course, I want to get your thoughts on the jobs report, and it comes on the heels, as I discussed earlier in the program, as the Congress and the president came up with a debt ceiling deal. Does that give a little bit of wiggle room, if you will, for the Fed to raise rates sooner rather than later? Of course, the market, I think, still expects somewhat of a pause, or it's at least torn on whether or not there'll be a pause in 2 weeks. What's your take here?
Yeah, I really thought the main obstacle to the Fed's ability to hike in June was actually the U.S. debt ceiling. I thought that was going to create the biggest obstacle if they wanted to actually do it. But honestly, I think they'd be running into a mistake if they hike at all. I know markets still believe that a hike is completely plausible in the next 2 months. Previously the market was pricing in a 100% chance that was going to happen by July. That has since kind of come down as a probability. But I think that we are still dealing with the aftermath of the U.S. banking turmoil. I think that we are undergoing a credit crunch at the moment. I believe that even though some of the Fed board members like Chris Waller is, he's being hawkish, he's kind of protesting against that. I think that probably in the back of their minds, they realize that in order to do this right now, it would be a complete mistake, particularly with the idea of a recession possibly coming very soon.
Do you think that, you talked about the credit crunch and the banking crisis. It seems that the local banking crisis may have subsided somewhat, that it was at least isolated to a couple of local banks that were too much skewed into technology and also had this long duration problem on their balance sheet. But it does seem now that there is a bigger problem in the housing market where mortgage rates have shot up and you have a lack of sellers in the market, and also a lack of buyers because there's people locked into these long-term mortgages. Do you think that that's also weighing on the Fed, saying, "Hey, you know what? This is kind of a bigger thing than we even expected." I would have assumed that they had that in mind, but nonetheless, do you think that the Fed is looking at this saying, "I don't know, maybe raising rates isn't such a good thing"? And then let's connect that to crypto. Does that mean that the markets are perhaps willing to take on more risk otherwise?
So the reality is, I don't think anyone knows, including the Fed. And you pointed to the retail sector, but also on the commercial property side as well. We really don't have a lot of good data on this. So let me kind of roll it back, because the first thing you kind of mentioned was, well, doesn't it seem like things have at least settled down? We have a facility that allows many of these banks to actually borrow, at least get back par. So even if they were marked to market, they were able to get some liquidity, and hopefully that should solve some of that problem. Well, you've also since seen that JP Morgan, for example, absorbed the First Republic Bank. First Republic Bank, famously, they're sitting on top of a large commercial real estate portfolio loan book. That's now sitting with JP Morgan. Like, what does that mean for JP Morgan's risk? Does it mean that it's non-existent? Is it flat? Is it higher? Is it lower? The reality is we really do not know, because we don't have the data backing it. Like we saw, for example, we got the senior loan officer survey that gave us some clues, but not really comprehensive data, right? Like we know, okay, like some of the commercial real estate sitting in San Francisco isn't doing so well, but we don't really know, like post-pandemic, for example, what are the occupancy rates of many of these buildings? What does it look like as far as, like recovery rates if there's any potential defaults on loans? We don't really have a good sense of these things. And that makes it really difficult to actually say one way or the other that we're done with the current bank crisis. And then there's the other aspect of, well, actually lending standards have tightened. we are actually seeing that credit is tightening. We know that for a fact because we've seen that people have been moving their funds out of bank deposits into money market funds. The more you do that, the more you're taking liquidity out of the system, and banks are not able to actually loan that out. And, you look at that number and you're like, oh, but, it's $500 billion since March, for example, a very big number, not even disputing that. But, finance 101, like banks rely on the money multiplier effect. That means that we could be talking about 3x, 5x, 10x of that number. Yeah. So at a minimum, that could be like $1.5 trillion of money that you can't loan out to people. What does that do to the economy? What does that do to the system? And I think that is what we haven't reckoned with yet.
But that of course, in that case, that spells actually a negative for crypto, because in that scenario, it doesn't matter that interest rates might not be as high as they were expected to be, but nonetheless, if there is a problem getting that money, it doesn't go into ultimately, Coinbase accounts, for instance. Is that what you're saying?
I think liquidity is going to be an issue for the next few months, for sure. And I think that's the most challenging part of looking at, pretty much all markets at this point, because we have this. At the same time, we have the resolution of the U.S. debt ceiling, and I think you kind of mentioned this at the top of the hour. Well, that also is possibly going to drain liquidity out of the system, because that means the U.S. Treasury is going to need to rebuild its Treasury general account balance. Probably that's about $1 trillion over the next year, for example. So we are going to see that there are going to be liquidity issues. Probably my guess is into mid Q3. After that point, perhaps there could be some potential catalyst that could drive this market higher. And I think for crypto in particular, I am constructive over the medium to long term, definitely as we get into the end of Q3, into Q4. But for the time being, I think that we're going to be in it for a very difficult time. And, as I mentioned, like it's all going to kind of hit at once, particularly with the recession on the horizon.
I want to switch gears here and ask you if you think there's a regained interest in stablecoins. And the reason I ask this is because Tether has reached an $83.2 billion market cap, and the company reported surpassing its previous peak from more than a year ago. Where do you think this interest is coming from?
Yeah, so seeing Tether occupy 63% of the stablecoin market was not on my bingo card at the beginning of the year. I think a few things kind of contributed to it. First of all, like if you look at the most recent attestation report that Tether produced, it is showing you that the capital ratio for Tether is now 3.1% compared to 1.5% in Q4. That suggests that Tether is a lot stronger from a capital standpoint than even some banks today. So I think that that is one big contributor to why Tether is where it's at. Number two is, we've seen kind of a shift, I think, from some of the more concerning algo stablecoins that we had in 2022, for example, into more fiat-backed stablecoins. And I think Tether has benefited from that. And that kind of goes back to the first point, right? The capital ratio is higher, so it looks better as a result. And number three is we've seen some of the impact to its competitors. Circle's USDC, for example, was impacted directly by the banking situation in March. We saw that there were some regulatory concerns surrounding BUSD and it's, the processing against Paxos. So I think that those things have also kind of supported Tether. And the last thing, which, I said there were three things, but this last thing, and it's more kind of tangential, and it's not really proven to me yet. But I do think that there's some positioning ahead of what's going to happen in Asia with, Hong Kong's opening to the retail market, retail and institutional market for trading large cap crypto names. And I think that Tether may be benefiting from that.
David, thank you very much for joining us this morning. That was Coinbase Institutional Head of Research, David Duong.